Okay, yeah, there we go. Thank you. Again, thank you so much, everybody, for joining tonight. This is Vinney Chopra, your host, and John Rusin. Actually, John is VP of the Academy, Multifamily Syndication Academy, where we teach all the principles of how to look into different commercial, investments, and also how to run them, how to underwrite them, all those kind of things. So tonight is a special night. We do coaching. Actually, I teach or coach every Wednesday, 2 hours, 1.5 to 2 hours. I've been doing it for many years. But tonight is a special session on tax planning for real estate investors. It's a webinar that our good friend Ted Lanzaro from Connecticut has joined, and we'll be talking about that. I do want to take over this one. John, maybe you want to read it, buddy? Because, yeah.
Of course. So welcome, everybody. Glad to have you. Glad you were spending your Wednesday with us. I know everybody's busy schedule. So quick little house rules. So welcome to this webinar. It's for educational purposes only and should not be considered as legal, accounting, or investment advice. This webinar does not represent an offer to sell or a solicitation of an offer to purchase an investment or security. The information presented is believed to be accurate and reliable. We make no representations or warranties expressed or implied as to the accuracy of such information, and we expressly disclaim any and all liability that may be based on such information or errors or omissions thereof. And then please consult with your own attorneys, financial advisor, and CPA for legal matters, investment, and specific tax situations.
Thank you, John. But okay, that's great. I do want to say a little bit. If anyone is interested, I have written 2 books. One is Positivity Brings Profitability. Just 3 months back, we published it, and we are getting lots of great reviews, 46 of them. Then the other book I wrote last year, just to kind of share, those of you who don't know me, Apartment Syndication Made Easy. We have over 300 some reviews, 208 in USA, and then 100 something across the world reviews. So that's a good one in Spanish and English. If anybody would like to know more about how to buy apartments, how to invest in apartments and things like that. Also, it's in audio. So if you are on the run or exercising, you could even put it right in your ear set and then enjoy that. Also, the 2 podcasts I do every week. That's Apartment Syndication Made Easy podcast, weekly show, and then Mr. Smiles, I Smile a Lot, Motivation Talk Show. So you could look also up in iTunes or Stitcher or, like those places, Spotify. I think we are all over. You could maybe, if you want to follow me, follow us, that'll be great. Our 3rd book is coming out very quickly. We are getting more and more into senior living investing because the silver tsunami is going through the country right now. 10,000 baby boomers are turning 65. So we are really very big on senior living also. So that book should be coming out very soon from all 3 of us. And we have 2 more shows. So I do 4 shows a week. One is also a Vinney and Bo show that comes on Friday live on Facebook and LinkedIn and YouTube live. If anybody wants to follow, that's the one on Friday, 9:30. And then we do on Thursday, 9 o'clock, Innovative Senior Living Show, because senior living investing is getting bigger and bigger and bigger. And tonight's agenda, we're going to talk about how can I qualify as a real estate professional? These are some of the questions that were asked before even we start tonight. How to maximize depreciation with or without a cost segregation study, how to maximize, safeguard your tax deductions. I mean, how to maximize your retirement plan and other deductible deferrals, why an S corporation could be better than the LLC, how to maximize the qualified business income deduction, all the different things. Is there a good year to convert my retirement plan to Roth? Why a repair is better than improvement on a rental property? What items always are considered repairs? How do I qualify for Section 179D tax credits on my buildings. This program is ending in 2020, and how to use entity structure to reduce audit risks. So things like that. And I'm going to just kind of stop the share and see all of you here and introduce our guest speaker for tonight, our good friend Ted Lanzaro, that you see right there. And Ted Lanzaro is a certified public accountant and real estate investor with over 30 years of real estate consulting and investing experience. And Ted is the author also of a book, The Tax Smart Landlord. That's another book you would like to follow. A book of tax strategies for real estate investors. And he has helped thousands of investors nationally save millions of dollars in taxes in his career. And excited to really have Ted presenting tonight. He also runs a CPA firm. I just wanted to say that, in Connecticut, which he's got clients all over USA in every state, and specializing in accounting. And also, one thing I like about Ted is that he's the investor CPA. He's the real estate CPA, not regular CPAs where you have to really tell them a lot about what kind of things you are doing and what strategies and things like that. So welcome, Ted. Thank you so much for joining tonight.
Vinney, thank you so much. I appreciate it. Thank you to John and all of you guys on the call tonight. I really appreciate you being here. I'm gonna just, should I share my screen?
Please. We'll go right into it. Yep. Thank you.
Let's see, and we'll get the ball rolling here. Start right from the beginning. Yep. Okay, so tonight we're going to talk a little bit. So Vinney already did this, so that was good. We saved us a little time. I've been a real estate CPA representing real estate investors for 30 years. I've been an investor myself for 20. I took a lot of that knowledge that I learned from both sides, the CPA and the investor side, and I wrote a book called The Tax Smart Landlord, and you can get a free copy of it on my website. And I've been working with investors I've worked with thousands of investors over the last 30 years. Here's the book. You can get it on the website, www.lanzarocpa.com. It's free. Just put your email in and you can get a copy. It's also, if you want a print copy, it's available on Amazon. So, and Vinney, I appreciate, you kind of also gave everybody an idea of what I was going to talk about tonight. So we'll go through these topics: real estate professional status, maximizing depreciation, safeguarding your tax deductions, your retirement plan deferrals, S corporation versus LLC, ROTH versus traditional, repairs and improvements, and entity structure, and then we'll take some questions. So the first thing I want to tell you, though, is that every one of you has a different situation. And there's a lot of different variables. So when we talk about tax planning, which is basically what I do for a living, which is developing a strategic plan that's tailored to the individual person. And when I say tailored, I do mean that everyone literally has different things that they can use. And it's all based on things like whether you own a business or you're a W-2 employee, or if you do own a business, are you in the real estate business, right? Because that can be a really big asset from a tax perspective. Are you a landlord? Do you own your own properties? We'll talk a little bit tonight about the difference between being a passive investor and an active investor versus a real estate professional. Are you married? Are you single? What's your income? The higher your income is, the more tax you're probably paying, and at higher rates. And then there's there's a bigger opportunity for savings, especially if you're a real estate professional. What are your goals and limitations? Sometimes I have a great plan to save somebody thousands of dollars in taxes, but I'm going to take their income down so low that they can't get a loan, right? So sometimes there's that situation. How many properties do you own? And do you actively manage them, or have a property manager manage it? Those things make a difference. What type of investor you are, passive, active, or professional. I'll define those for you in just a second. So a passive investor is an investor who basically invests in other people's deals for a return on their investment. Okay, a good example of a passive investor is somebody who invests in one of Vinney's syndications, right? And they invest with the idea that they're going to put their money in, they're going to get a return on their investment on a cash flow on a quarterly basis or annual basis, whatever the particulars of the deal are. And then when the property sells, they might get a piece of the back end also. So they're doing it strictly for a return on investment. They have no control over the operations of the property or anything like that. Okay. Now, you can also be a passive investor if your income exceeds $150,000 a year, because the second category is an active investor. And the reason you want to know what kind of investor you are is because it determines whether or not you're able to deduct your rental losses against your ordinary income. Okay, so passive investors typically cannot deduct their losses created by depreciation against their ordinary income. They can deduct it against other passive income. If they have a lot of rental income, then having some passive losses will help decrease the tax on that passive income, but they're typically not allowed to offset it against their W-2 or earned business income. As an active investor, if I make less than $150,000 a year as an active investor, I'm able to deduct up to $25,000 a year of rental losses, typically created by the depreciation on the property, against my ordinary income. So I have a client that was working on today. Client makes like $102,000 a year, has several rental properties. We did some cost segregation breakouts, like I'm going to show you, on some properties they bought this year. They got an extra $20,000 of depreciation. They'll be able to take that rental loss against their ordinary income because they actively manage the property. So now, instead of paying taxes on the $102,000 they make, they're actually only going to pay taxes on $82,000. And in their bracket, which is about the 20% bracket, give or take, that can be a $4,000 to $5,000 difference in the amount of taxes they pay during the year, because we spotted it early and we showed them how to do the breakout of the depreciation. Now, once your income exceeds, your adjusted gross income exceeds $150,000 a year, even if you are actively managing your own properties, you lose the ability to deduct those dollars against your ordinary income in that year. Now, the loss, you never lose the loss. The loss actually carries over to the following year and is usable in a few different situations. One, your income goes below $100,000 for a particular year, and you're able to use the losses. Or if you have additional rental income in subsequent years, you're able to use the losses against that. And you're always able to use any losses that you've accumulated in the year you sell the property. Okay, so you never lose the rental losses that you accumulate. Now, the third category, which is sort of the holy grail of real estate investing, is real estate professional. Real estate professional means, and we'll go over this a little more in detail, means that I can deduct all my rental losses typically against my ordinary income if I have the basis to take the loss, meaning that I've contributed money to the investment, okay, and I've qualified as the real estate professional, and I've actively participated in the property. So let's talk a little bit about what makes you qualify as a real estate professional. And so the first qualification is I must have put at least 750 hours into a real estate related business. And these businesses, if you look at number 5 on that list, these businesses include things like real estate development, real estate redevelopment, like flipping houses, for example, or flipping, apartment buildings, construction, of homes, residential or apartment buildings. Acquisitions, like when you're in the syndication business and you're acquiring rental properties. Conversion of properties, buying properties and changing their use. Say, for example, I was involved in one not long ago where we took an old industrial warehouse and turned it into apartment buildings. Rental operations, meaning you're running a landlording business, either your own properties or maybe you're like Vinney and you have large apartment complexes all over the country that you're operating. Property management, if you're a property manager, either for yourself or for other people, and leasing and brokerage, which means you can be a real estate agent or broker and qualify. Now, the other thing that you can do, let's say, for example, if you're married and you file jointly, your spouse can qualify as a real estate professional. So I have a lot of clients who one spouse is, say, a doctor or somebody with a very high income, and the other spouse is a real estate agent or a property manager or in the syndication business. One of them has the high income, the other one is the professional that now can qualify to take the losses against that income. So it's really a nice situation where you can kind of pair those two together. And one of the things that I always tell people is one of the biggest red flags for the IRS is somebody who has a W-2 job and is claiming to be a real estate professional, right? Because let's say I have a full-time W-2 job and I work, 2,000 hours a year, right? Well, now it's not just 750 hours, it's because it's 750 hours and it has to be more than 50% of what you do in total. If I have a full-time job, 2,000 hours, I've got to work 2001 and document 2001 real estate hours in order to qualify. And I certainly wouldn't want to go to the IRS and say, I only made it by one. So I encourage my clients, I'm not the kind of guy who, like, if I'm watching a ball game or something, I don't want to win by one run. I want to win by 4 touchdowns, right? So I would encourage everybody to have more than enough hours, right? And so what that really means is I should be running an actual real estate business. So I know a lot of people try to kind of, work the numbers in their favor and say, but I want my real estate professionals to be doing something that's regular, continuous, and substantial that they make money at, right? So the best real estate professionals are, people that are in these development, redevelopment, acquisition, brokerage, management, right? They're actually doing the business and making money at it, right? And then they have rentals and investments on the side that qualify and have these losses that they qualify. And people often ask me, well, what activities actually qualify? Any activity that's related to the operation of your business or the marketing of your business qualifies, right? So people say, well, does education qualify? Well, think about going to an educational event, right? If I'm at a, and this is kind of old school because with COVID, we're not doing a lot of live events, but back, a year ago when there was a lot of live events going on, people would go to live events. Is the time spent sitting in the classroom actually time as a real estate professional? And I would say no, but the time I spend in the hallway networking, talking with John and Vinney about their next deal is, right? Why? It's the marketing of my business, right? So what I tell people is when you go to document the hours, and you can use an app or a spreadsheet or a day timer or whatever, however technical or, technology oriented you are, you want to be as detail oriented as possible. And you want to kind of basically make a list of the things you commonly do in your business, right? So if you're a landlord, for example, actively managing your own properties, one of those activities might be collecting the rent. Another activity might be the bookkeeping. Another activity might be showing the apartments, dealing with your property manager, whatever those activities are. keeping track of those and making a list of the most common so that you can go and have the log of hours that you need to document your deduction. So it's really a great strategy. We're going to talk more about the strategies you can use when you're a real estate professional, but just know that it's a great opportunity that comes with some responsibility. So here's some of the strategies that I use with my active investors and my real estate professionals. You know, a lot of you know what cost segregation is. And I'm going to give you an example in just a minute. Cost segregation is just the process of allocating the cost basis of a property that you purchase into its individual categories that the IRS says exist. In other words, there's in every apartment building, for example, there's 5-year tangible personal property. That's anything that I can unplug, unscrew, detach somehow and walk away with. So it's stuff like the appliances, the kitchen cabinets, you know, tubs, vanities, mirrors, lighting. All of these things are typical things that qualify as 5-year assets. 15-year assets are the land improvements. So they would be things like the parking lot, the sidewalks up to the doors, for example, landscaping, fencing, retaining walls, that sort of thing are all considered land improvements. They're depreciated over 15 years. Both anything that qualifies for 5 or 15-year treatment is also qualifies for 100% bonus depreciation in 2021 through 2022, meaning that it can be depreciated all in 1 year, the first year of ownership. So that's great. There's also a process called an abandonment study, okay? So an abandonment study is a type of cost segregation study where what we're going to do is if we know we're going to renovate an extensive part of the property, we do a cost segregation study when we buy the property. And then we basically make a list of all of the things that are there. And then after we renovate and we keep track of all the things that are going into the dumpster, right? Literally as we're pulling things out, right? Then when we do the new cost segregation study, we can write off all of the things that were allocated in the original study that were thrown away. So I had a client bought about a 200-unit apartment building in Lexington, Kentucky, $7 million. They did a cost segregation study, identified $1.5 million worth of items that went into the dumpster, literally during the renovation of the property, right? So that did reduce the cost basis of the property, but all of the investors got their share of a $1.5 million tax deduction in year 1. And the abandonment loss is not subject to the passive loss rules. So all the investors participated in the write-offs of that. Right? And then they got the new cost segregation study had all of the new stuff that went in there, and they got the typical depreciation on that. So first year they got $1.5 million allocated in the abandonment loss, and another about $1.5 million allocated in first year depreciation. So they were pretty happy, right? The other thing we're going to talk a little bit about, the other thing we're going to talk about is maximizing your deductions, right? And how to do that, how to safeguard them. Because a lot of people leave things off of their rental schedules, frankly. And I have to go back and remind them, hey, did you have this expense? Did you have that expense? Everybody knows, that you can deduct your mortgage interest and your insurance and your real estate taxes, but a lot of people leave a lot of the administrative, the office kind of expenses and the travel and the meals and, an allocation of personal expenses, an allocation of your cell phone, your business miles to and from the property, those kind of things that are actually tax deductible. So, and to help you to maximize. And the goal is always to maximize the loss so that you can minimize the tax, right? So what is depreciation, or why is it so awesome? Well, depreciation is really nothing more than the rational allocation of the purchase price of the property. And the IRS sets these standards that we've discussed, and they say, okay, well, certain things are going to qualify for 5-year depreciation and certain things are going to qualify as 15. And the rest is going to be in a residential apartment building. The rest is going to be 27.5 years depreciation. So if you bought a $2.75 million property, you would, to use simple math, you would depreciate $100,000 a year if you didn't do a cost segregation study, right? If you do a cost segregation study, you may be able to really push the envelope and really take a much larger deduction. I'll show you what I'm talking about. So what's the proper way to break out the cost of the property? Well, typically, and I'm going to use a small example, but you can just add a 0 to these numbers if you wanted to, right? So let's say we have a $500,000 rental property. And typically what the average accountant is going to do is they're going to use something that most accountants use called the 80-20 rule. They're going to allocate 80% of the cost of the property to the building and 20% to the land. And they're going to depreciate that building over 27.5 years. And they're going to end up basically with about $14,545 worth of depreciation on that property, which is literally 400,000 divided by 27.5, right? Now, what I typically would do is I would say, no, wait a second. And we can do this with a cost segregation study. Typically, this is done with a cost segregation study, right? And the benefit of using the cost segregation study is you're going to get two things. One, you're going to get the most aggressive legal allocation. So they're going to catch everything. They're going to catch all of the 5-year assets, and not only that, but they're going to do engineering-based allocations of the electrical wires, the plumbing, because everything that's connected to a 5-year asset is a 5-year asset. So you have a 5-year asset, a refrigerator, but the electrical line that runs that refrigerator and the plumbing line that might be connected to the ice maker or something is also part of the cost of that refrigerator. Now, let's say you're doing a small property like this, $500,000, say, and you're like, oh, well, you know what? I really, I can't even get somebody to do the cost segregation study, or it may be a little expensive or whatever. I can still do a basic allocation, right? By going in and identifying all the 5-year assets and just conservatively allocating some dollars from the purchase price. So in this scenario, this is kind of what I've done. I've identified on this $500,000, let's say this is a 3-family house in wherever, right? I've identified $40,000 of, if in a 3-family, you'd have 3 kitchens and at least 3 bathrooms. So you'd have, 3 sets of appliances, 3 sets of kitchen cabinets, 3 sets of, shelving, and a lot of lighting and all the things that go into a bathroom. So when I added all that stuff up, it came out to about $40,000. And I have a driveway, which I know it would cost me about $10,000 to pave. So I allocated about $10,000 to that. I haven't done a cost segregation study, and this is not as bulletproof, but it can be done. And if you want to bulletproof it, do the cost segregation study, and you'll get a lot bigger allocation, because typically cost segregation is going to net you about 20% of the purchase price in a residential apartment. So this is a little more conservative. It's more do-it-yourself on smaller properties. Anyway, what you end up with is in the first year, you would end up with like $50,000 of depreciation on top of the extra depreciation you would get. So you're looking at a big difference using bonus. This example only uses regular depreciation, but if you add the bonus depreciation to this, you're looking at an extra tax deduction over $50,000. This is kind of an older slide. So we talked about that you can deduct the items that you dispose of during the renovation. I gave you a big apartment building example, but you can do the exact same thing on smaller properties. You just need to keep track of them by documenting the items that you dispose of, by taking pictures of them, identifying them, and applying a conservative cost to them. Okay. So let's talk a little bit about maximizing and safeguarding your tax deductions as an investor, right? Typically when I see a lot of people leaving money, a lot of investors leaving money on the table because they don't have a good accounting system, right? That captures all of the expenses that you have. So what I recommend people typically do, right, and is that if you have your own properties that you're managing and a portfolio of those, you want to have one bank account that collects all of the rental income and pays all of the expenses. And you want to have a dedicated, say, debit card that you use so that when you walk into Home Depot or the paint store or whatever, you use that card instead of reaching into your pocket for cash, right? Typically, that's how people lose deductions. The worst thing, if you have one bank account, you use a debit card or a dedicated credit card for that bank account, then the worst possible scenario is that all of your information is on those bank statements. You turn it over to a bookkeeper and you've captured all of the tax deductible items related to that property or those properties, right? You can't lose anything because think about somebody who walks into a store, maybe buys. I had a guy yesterday tell me he went to Home Depot, bought $4,000 of stuff, and he used cash. And he's like, well, wait, but I got a receipt. Okay, well, are you going to put that receipt into your software? How are you going to, how are you going to account for the fact that you just happen to be walking around with $4,000 in cash on, right? That if that receipt literally, if he loses it or it blows out the window, he's probably going to forget it. And what happens? He loses that tax deduction because he doesn't remember it happened, right? So you want to make sure that all of this stuff is on your bank statements, in your banking activity, right? You also want to keep all of the receipts and all of the important paperwork related to your properties, right? And just use a simple filing system. I have a little box, with the green little hanging folders, and I have a category for each thing, and I put my receipts in that box, and then at the end of the year, that's my 2020 box. I put a lid on it, and I put it in my garage, and store it, and I have everything. God forbid I were to get looked at, in an audit or something. All my paperwork's there. It doesn't scare me. Why? I'm organized, right? I've got all my information in one place. I've got a box of all my receipts. I've documented all of my repairs and renovations with pictures, right? I sent 1099s to my subcontractors. Had a guy call me today. He's like, oh, I'm doing some renovations on one of my rental properties. He's like, I'm paying the guy, but the guy doesn't want a 1099. I'm paying him in cash, right? How am I going to be able to deduct that? I don't know. Maybe you shouldn't be paying the guy in cash, and you shouldn't be using, unlicensed people who don't want a 1099, right? That'd be a good start, and so, there's so many things that can happen when you use, and this is part of the, not the CPA advice you might get from me, but the investor advice that having somebody who's been there and done that, has renovated, over 100 properties, knows, that these are the things you need to be doing as an investor to protect your properties. So using licensed contractors, making sure that you get the W-9 from them before you pay them, right? Is always a good habit to do, because once you've paid them and now you're looking for the information to send them a 1099, there's a really good chance you're not going to get it, right? And the other thing is, don't miss any of your administrative expenses. I send my clients literally a checklist. Here's all of the things that you should consider that are administrative expenses that most investors are leaving off their tax return, right? So do you have any of these things? And if you do, please provide me with the amounts so that we can deduct them, right? And it's stuff like business miles, right? Hey, I drove all around, to manage my properties, right? Don't miss those kind of things. You're leaving money on the table when you do. So we'll switch gears here for a minute, and we'll talk a little bit about retirement plans and health savings accounts and how to use these things as deferrals, whether you're a W-2 employee or whether you own your own business. The difference between, so when we talk about retirement plans, the difference between a traditional retirement plan and a Roth retirement plan has to do with the treatment of the contribution going in and the distributions going out. In a traditional retirement plan, I can take a deduction for my contributions. And when I get older and I take distributions out, once I've retired, I'm going to pay tax on those. In the middle, I'm going to get tax-free growth. So I can put $20,000 in, I can get $10,000 worth of growth. I get a $20,000 tax deduction at the beginning. I don't pay any taxes on the growth, but then I do have to pay taxes on the money I take out as I take it out. Okay. In a Roth IRA or a Roth retirement plan, I don't get any tax deduction up front when I make the contribution. I still get the tax-free growth, but I don't have to pay the taxes when I take the money out, assuming that I leave it in there for at least 5 years. Okay, that's the general rule. Okay. Now, typically what we want to do, and a lot of times, so I have, a lot of clients who, they make good money. Maybe they're making a couple $100,000 or more a year, right? But they're also living on a lot of that money, right? So maybe they're not maxing out their retirement plan contributions at work or with their business, right? So so now let's say they're invested in some properties. They have some real estate properties, and they can use the cash flow. So the whole point of owning rental properties is that I want to have tax-free cash flow. So I'm going to use depreciation against my net income in order to wipe out the tax on the income, but I still have the money. So let's say I have $20,000 in rental income from my rental portfolio, and I've got $30,000 of depreciation on that same portfolio. I actually have a $10,000 loss on the property, so I don't have to pay tax on that income, but I still have $20,000 in my pocket, right? And let's say that's an extra $20,000 that I don't need to pay my bills, right? Well, I can use that money to make my retirement plan contribution, right? So I can go to my employer and say, please max out my retirement, my 401k, because I've got this extra income this year to make up for it, right? And what ends up happening is I got this money tax-free, and then I used it to create another tax deduction. So I've double dipped, right? I got dual usage out of that $20,000. I didn't pay tax on it. I made it, but I didn't pay taxes on it. And then I used it to create a deferral, right? So that's a great way to use both your cash flow from your rental properties and the cash flow from your syndications in order to get additional tax deductions with that cash flow, right? Because you're not paying tax on it. And if you can use it in such a way as to get you more tax deductions, awesome. That's even better, right? The other tax deferral that people have that they don't often max out is your health savings account. If you have it these days, if you've got any kind of, health insurance, a lot of times it's a high deductible plan, right? Even high deductible plans have outrageous premiums these days, right? So you typically would want to use a health savings account, and you can put away somewhere in the neighborhood of about $3,400 if you're single, and somewhere in the neighborhood of $7,000 as a family every year. So you should be maxing that out to the extent that you can afford to do so. So once your cash flow from your rentals has been used on your retirement plan, maxing it out, max out your health savings account also if you've still got money left over. It's an additional deferral, right? So that's a great way to create a lot of tax loss. And I just did a tax plan today where I helped a client of mine put away literally $70,000 in their retirement. It's a couple. They flip houses and they have a bunch of rentals. They made quite a bit of money flipping houses this year. Because they're real estate professionals, part of their rental portfolio offset their net income, but they still were able to put about $70,000 away in their retirement plan. That saved them almost $25,000 in taxes, right? So it's a great way to use dollars to create really big tax savings, right? And then you have the money for the future. And you can self-direct that money and invest it in syndications or other real estate. So you're not locked into the stock market. All right, so I get this question all the time. Ted, why would I want to have an S corporation instead of an LLC, right? So if you're operating business, okay, and it could be any kind of business, active trader business is what you do for a living, and you own it as a single member LLC, or you're in a partnership, maybe it's you and your spouse, or you and your family member, or you and a friend, whatever, right? Whatever income you make in that LLC is subject to what's called self-employment tax. That's over and above the federal and state income tax you're going to pay. Self-employment tax is the Social Security and Medicare that if you were a W-2 employee would be taken out of your paycheck and then matched by your employer before they send it to the IRS. When you're self-employed, you're both the employee and the employer. So you get to pay both sides. It's 15.3%. So on $100,000 of net income, you're going to pay $15,300 of self-employment tax, right? Well, if I use an S corporation, I can change those rules. The rule is I only have to take a reasonable salary and pay the self-employment tax on that reasonable salary if I'm an S corporation. So what I do is I typically use about 50% of the earned income. So on $100,000 of income, I would take a $50,000 salary, pay in $7,650 in self-employment tax, and the rest, the other $50,000 that I'm going to take out, just write myself a check as a distribution, is not subject to the self-employment tax. So I've now saved $7,650 on my taxes on $100,000 of income. And the more you make, the more you save, right? Here's the other great thing about this strategy. We're going to talk a little bit about using entity structure to save money, but I'm like you're 6 times more likely to be audited using a single member LLC on your personal income tax return than you are if you file as an S corporation using the S corporation business tax return. You get a K-1 from the S corporation so that the details of your business income and your business losses are not on the face of your personal income tax return. It's literally one number, $100,000 or $50,000. You know, the K-1 would have $50,000 on it, and your W-2 would have $50,000 on it. There's no detail of how you arrived on that number on your personal return, unlike if you use the LLC. So single member, especially if you're in the real estate or construction business, especially the construction business, you are literally 6 times more likely to be audited if you have about $100,000 income on a Schedule C of your personal income tax return. Here's a question I've been getting a lot this year, because this is one of the first years, especially with 2019, this was the first year that you could do a carryback to past years if you had bonus depreciation on your real estate that exceeded your ordinary income and you were a real estate professional and able to take it. So I have a guy who made about $400,000 this year, but he bought like 4 properties, right? Big properties, and he did cost segregation studies on them. And he has $1.5 million of bonus depreciation this year. So he has a net operating loss of $1,100,000, right? And so the first thing he's able to do is, and so the law says, the new law says that you're able to carry back that loss and get back all of the taxes you paid over the last 5 years. So in 2019, when he did this, and we carried it back to 2014, 2015, 2016, 2017, 2018. We wiped out all his income for those 5 years, and he's going to get like a $300,000 refund back, right? That's all the tax he paid in those years. But he still has like $400,000 left. And he can either carry that money forward, or he can convert his retirement plan to Roth. And when you convert a retirement plan from traditional to Roth, typically you have to pay the tax on the dollar amount of the conversion, right? So in this case, I said, well, you have $400,000 left over. You bought even more properties in 2020, so you're going to have even more depreciation. You're not going to be paying taxes on your income for years to come, right? So this is a great year for you to convert your traditional plan to Roth. Use that $400,000 this year, and basically what he did was he did a conversion, and the bonus depreciation wiped out the income that the conversion was on. So basically, he did a tax-free conversion. So so there's other situations that you might want to do that, but the idea is to try to convert your traditional money to Roth money at a time when your income is at either at its lowest, so it's of the lowest possible rate, or when you have a huge bonus depreciation kind of loss, where then it literally wipes it out, right? And the advantage of that is now I don't have to pay tax on that money, and I can make it grow. So I have another client who's using this strategy really well by basically buying apartment buildings in his Roth IRA. He has quite a bit of money put away. So this is a strategy for somebody who's got a lot of money in their Roth. But he bought like a small apartment building, started out at like $400,000, fixed it up, filled it with new tenants, and turned around and sold it a year later. Made a couple $100,000. He did it again, made a few $100,000 more. You know, now again, he's doing this in 2 and 3 year increments. It's not a fast thing. But over the last 10 years, after he converted his Roth, he's added $1 million to his retirement account that he will never pay taxes on, ever, because it's in a Roth. And he made the Roth grow by investing the money. So, you know, that's far more growth than he would have ever gotten in the stock market. So this is a very good strategy, you know. And again, it's got to be tailored to your situation, but if you're in that situation, it's a great strategy. So let's talk a little bit about repairs versus improvements. And this is for the people who have their own properties typically, or are running maybe a syndication where they're running the property. What is the difference between a repair and an improvement? A repair can be deducted in the year you pay for the repair, right? So it's instantaneously deductible. An improvement is basically, so when you do a repair, you're basically fixing something, okay? When you do an improvement, you're renovating typically. So in my example before about the apartment building where they went in and they gutted the apartments and put in all new stuff, those were all improvements, right? And improvements have to be capitalized and depreciated, and they can be cost segregated into 5, 15, and 27.5 years, but they still have to be depreciated over some life cycle, right? Whereas repairs are deductible expenses in the year, and you get to take the deduction in the year that you paid for it. Now there's certain items, and this is something that a lot of people don't know, but the IRS came out with some new rulings about 7 or 8 years ago, where they basically said the following items are always considered repairs, right? And these repairs include, in the definition, include things like driveway and parking lot replacement. Not the original parking lot you put in, but when you go to replace that parking lot, that's considered a repair, okay? Not the original roof you put on the property, but when you go to replace the roof, it's a repair. It doesn't have to be capitalized as an improvement. Painting is always a repair. Flooring replacement is always a repair, right? Heating and cooling replacement, always a repair. The only exception to those rules is if you use superior materials when you do the repair. So if you're replacing vinyl flooring with marble, that's an improvement, right? So you always got to, you know, if you're putting granite countertops in, when you took laminate countertops out, that's an improvement, right? So you don't want to do that. You want to be able to do the kind of items, the kind of renovations that are always considered repairs, right? Why? Because I get to deduct them in the year. So I always tell my clients, look, I want to hear from you. I'm a very proactive guy. I want to hear from you before you buy a property, before you sell a property, and before you renovate a property, because I can tell you the best way to renovate the property. And that's CPA knowledge, but it's also investor knowledge. What is the best way to do that in such a way as to maximize the tax efficiency and the tax deduction, right? It's important stuff. And it can be a huge difference. It could be the difference between taking a $50,000 repair deduction versus capitalizing $50,000 and deducting it literally $2,000. So the last thing we'll talk about is entity structure and how entity structure reduces audit risk. I am a big proponent of using LLC partnerships instead of single member LLCs for holding rentals. Now, in the syndications, you're always doing this, right? You know, all syndications are typically either partnerships or LLC partnerships. But a lot of people own their personal properties or personal portfolios just in single member LLCs. And what happens is those single member LLCs get all the rental income and all of the expenses, all the details of the expenses get reported on Schedule E of their personal return. And it's the same thing we were just talking about when you're running a business and you're reporting all your business income on Schedule C. Everything's there for the IRS to see on the tax return that you pay tax on, right? So the strategy, the audit prevention, audit risk management strategy is to get all the detail off of the return that's more likely to be audited and onto a return that's less likely to be audited. So partnerships only get audited at 20% the rate of individual returns. Why? Because the IRS doesn't send auditors out unless they think they can get a return on their investment. So what they're looking for is how much tax can we get back for the amount of money we're going to pay the auditor, right? So the same way you would look for a return on investment, you know, on your properties, they're looking on a return on investment out of their employees, right? So it makes sense if you can do it, right? A very common way to do it is put your spouse on it, right? That's what a lot of people do, right? So it provides you with audit protection. It does have some downside, right? But it's a good asset protection strategy and it's a good audit protection strategy. Let's just talk, and we'll finish by talking a little bit about what is tax planning. And what I do is customized and tailored to your specific situation. So the first thing I do is analyze and understand your situation, your goals, right? What are you trying to accomplish? We look at what you're doing and how you're doing it, and develop a tax plan that will minimize not only your current year taxes, but comparing that to what your tax liabilities might be in 2021, 2022, 2023. Because sometimes if I know you're going to have more income in 2021, I may suggest you don't do something that minimizes your income in 2020. We always want to put the strategies in place in the year that you're going to get the most bang for your buck. And that's going to be the year that your tax rate is the highest. So we look at multiple years, right? In order to do that, we prepare a tax projection that incorporates the plan. So I always do a projection that says, here's where you are right now if you did nothing. Here's option number one, option number two, option number three. You know, here's the various things that you can do and how much your tax savings is, right? And once the person selects which option they want, then we implement the plan, and we also put in place all of the information that you need to document what you're doing, right? So that it's bulletproof. It's you know, you have all of the information, you have all the records in order to do that. Now, considering that we don't want you to pay, we want to minimize your taxes, we certainly also don't want you to pay any penalties or interest, right? Because all that is additional tax. So we make sure that you have a sufficient amount of taxes paid in, whatever that minimum amount is, it's paid in at the right times to avoid penalties. right? So that's basically kind of the essence of proactive tax planning. Most of it has to be done before the end of the year. So that's literally all I'm doing right now. From October 16th to December 31st, I am sitting with my clients and devising and planning and tailoring strategies to their situation to save them thousands of dollars a year. I would love to be able to do that for everyone, you know, and I'd love to be able to do it for you. If you're interested in something like that, you can email me at ted@lanzarocpa.com for more information. I have to be honest, I don't have a lot of spots left, you know, so you know, there is some urgency. So I'll take questions now if you want.
No, thank you so much, Ted. Such a great presentation and so much, you know, so many topics were discussed. So let's open up. Do we have some questions, John? And maybe even we could open up microphone so that people can ask. That'll be fine too. That'll be terrific, huh?
Or so if anybody wants to come off of mute, you can unmute yourself, and then or if you don't want to come off mute, you can put it in the chat. We'll bring it up. So
Please. Yes.
The first question is, what is an LLC partnership?
So any LLC that has more than one member is considered a partnership.
More than one member. Yeah.
I think someone came off mute. So if you guys, whoever wants to ask next.
Okay. Yeah. Please go ahead. If you'll put it in the chat quickly, that'll be great. Or unmute and then ask us. And thank you so much, Ted. You know, we did good. You know, 1 hour, almost 55-minute presentation, and it's been recorded also. And we are going live on Facebook also. So if there are any questions, that
yeah. Hi guys, I have a question. Demetrius Brown from Tampa, Florida. Ted, are they going to in the future do away with the allocations of the tax savings from the Roth IRAs?
What is the question again? Say that just one more time.
Roth IRAs.
Yeah, I don't know. I guess there was like rumors in the grapevine that it's not going to continue to be around in the distant future to be able to have those tax deferments for real estate related to the Roth IRAs. And I just wanted to know, have you heard anything about that?
You know what? I have not heard anything about that, but that doesn't mean that it hasn't been talked about. There's always going to be things that get bantered around, and one of the big things was the 1031 exchange, the bonus depreciation, what's going to happen. You know what? None of us have a crystal ball. We all have to operate under the system that exists at this point, right? One of the things that I would tell you is that the Tax Cuts and Job Act, right, that got passed at the end of 2017, that was pretty popular with rich people. And there's both there's rich people on both sides of the aisle, right? And they all have the ear of their representatives, so anything that really hurts wealthy people, is going to be difficult to pass.
Right.
Sure. How about 1031? Ted, again, we don't know, right?
We don't know, but look, you would need control of the Senate to pass that, right? And even if you did have control of the Senate, you don't think, people like Chuck Schumer and Nancy Pelosi represent the richest people in this country, right? Are you going to call Nancy Pelosi and tell her, don't do away with the 1031 exchange, right? There's a lot of people like you that would get on the phone and say, hey, look, that's not going to be good for the industry. I'm an expert, right? Don't vote for that. So look, there's going to be lobbying and stuff, and so it's probably not going anywhere. And if it does go somewhere, it'll probably have. They were talking about 400 for people over 400,000. If they did pass it, it might be something. It might have a much higher limit, right?
Sure. There was a question.
Yeah, Ted.
Please go ahead, Merle. Yeah.
Ted, hi. This is Merle. I have a question. I'm going to turn 70 in a couple weeks, and I have to take I've been taking my late husband's Social Security, and now I'm going to be taking mine. So my income from Social Security is going to increase by $20,000 a year. And I have money in an IRA account, and I'm wondering if I should take the money out of that IRA account and put it into a Roth now and pay the taxes that I would have to pay this year, rather than when I'm earning 20,000 more next year.
Yeah, I mean, that would be that. I don't know that I would recommend that for you. I would really want to look, I would have somebody look at your situation. I could do it for you, or you could have your existing CPA, because you may be better off. Don't forget, you don't have to take that IRA money out. When you turn 70 and a half, they'll force you to take what's called a minimum distribution of that money, but it won't be all the money. It'll be a very small piece of it, because it's designed, to be, an annual payment that's supposed to last your lifetime, right? So you may be better off. Paying a little at a time, instead of without knowing how much money you have in there, and without, we don't want everybody on the call to know how much money you have in there. So, there may be something you want to do. We could do the math on for you, but it's more likely that you'd be better off just taking it out of the left.
Okay, so I'll make an appointment with you.
Okay.
Sure.
Thank you.
Thank you. Thank you so much. I think there are some other questions. How do passive investors use the cost segregation depreciation?
Well, if you're a passive investor, you're not going to get the big losses against your ordinary income that a real estate professional would get, right? So what are you going to get? Well, you're at a minimum, you're going to get tax-free cash flow, right? And you can use that tax-free cash flow to fund deferrals like your retirement plan or your HSA. You can use it to offset other rental income that you have, right? And in the worst case scenario, you can use it to offset the capital gains on the sale of the property when the property is sold.
Sell. Yeah, sure. Yeah. So actually the question was, Ted, like the passive loss from one asset, can it be batted against the passive loss from other for the same individual in that year?
If you have passive income from one asset and passive loss from another, they offset.
They do. Okay.
They do offset, yes.
Excellent.
Yeah, that would be an offset of rental income.
Rental, yeah, rental, not the primary residence, but the rental income and, okay, right. Now, how many years can you take your passive losses accumulate until how many years in the future?
It's funny, the answer is 20 years, but I've never had a situation where anybody got even close to that. And the reason is, think about syndications specifically. Most syndications have a specific, at least range of life, right? Yeah. So you invest in a syndication, you're expecting to get your money back in 5 to 7 years, typically, something like that, right? Sure. So the worst case scenario is if you couldn't use any of the losses, you'll get that tax-free cash flow for 5 to 7 years, and then be able to deduct whatever's left over against the capital gain when they sell the property. I haven't seen anybody up against the wall with passive losses in 30 years.
Beautiful, beautiful, very good. Okay, there is go ahead, John, buddy.
Yep.
Yeah.
So is bonus depreciation going away from next year?
Bonus depreciation is not going away, barring a complete overhaul of the tax code. Now, for next year. Now, bonus depreciation is based on the Tax Cuts and Jobs Act that created it. Bonus depreciation is scheduled to be 100% for 2020, 2021, and 2022. And then in 2023, it reduces to 80%, 2024, 60%, 2025, 40%, and then 2026, 20%, which means it's basically gone.
Ah, all right, good.
But I can remember back in the 90s when we were doing cross segregation studies and people were thrilled just to get 5-year deductibility instead of 27.5-year deductibility, right? So it's bonus depreciation is awesome, but you also a lot of people get it and then can't use it. So
Sure. I just took over so that we could all see everybody's faces. No, let's see. What are other questions?
There's 3 more, and I think Ruby has one as well. So Ruby, do you want to go next, or are you there, Ruby?
Yes. If you are holding rentals, and let's say they're single family or if multi-family from 1 to 4 units, how would you structure your business foundation in order to get the best tax shelter and asset protection?
Okay, so if I had, how many are we talking about?
Let's say I have one right now, and in year 2021, I'm looking to put maybe 5 rentals.
Okay. So it really it's a question that doesn't have a definitive answer. Okay, and the reason that is because there's a thought process about what your risk tolerance is. Okay, so from an asset protection standpoint, from an accounting and tax standpoint, I would set that up so that you had one company, no matter how many LLCs you have, or even if they're all in your personal name. I want to have one company that collects all the rents and pays all the expenses, right? And the reason I want that is what we were talking about before. I want all of the information in one place, right? That way I can't screw it up, right? The worst possible scenario is everything's on my bank statements and I can always just turn it over to a bookkeeper and know what my profit and loss is for. So I'm gonna make sure that I'm maximizing that. I'm also going to make sure that I have the tracking in place for all of the allocations of my personal expenses, things like my business miles, my home office, say for example, if I'm running it from my house, an allocation of my cell phone, all of those things. Now, from an asset protection standpoint, there is literally an unlimited variety of options of things you can use, a lot of which have to do with various variables. Like I would give you a different strategy for 5 properties that have 90% debt on them versus 5 properties that are free and clear. Completely different strategy. I would give you a different strategy for 5 properties that are Class A versus 5 properties that are Class D, right? Because they're a different risk profile, right? So it really has to do with risk tolerance, what type of properties you're talking about, and what the debt on them is. That basically, helps you formulate the right mix that both protects you and is cost effective.
Okay.
Thank you.
Yes, thank you.
Perfect. John, next one, bud. Yeah.
So if you are an LP in a syndication, you are not actively participating. So why would an LP get to depreciate the asset?
Well, as an LP, you're getting the pass through of the depreciation. It's just a matter of whether you can deduct it or not. And the answer is you probably can.
Yep. So
But that doesn't mean you never can deduct it. It just means that most of in the year that you have the loss, the big loss, probably the first year you invest in it, you may have to carry it over in order to be able to use it. You can use it against your other rental income if you have a more active portfolio, and you can use the cash flow to create additional deferrals. But yeah, you might have to carry it over. But you're getting allocated depreciation whether you like it or not, basically.
So the next one, so there's 3 more. So if my spouse is a real estate professional, what am I using to offset my W-2 income, comma, depreciation, and then question mark?
Yeah, the depreciation. If your spouse is a real estate professional and you own rental properties, right? Or you're active in a syndication or whatever the scenario may be, maybe you're a syndicate, right? Well, then my spouse is a real estate professional. Now I'm eligible to take those losses, assuming that I qualify for the other, the other criteria, which is I have basis and I actively participate.
Awesome. So
Thank you, John.
yep, you're welcome, Duhamel. And then so the next one, so went down. So it's a follow-up. So would my wife and myself in an LLC be considered a partnership LLC?
In most states, yes.
Well, the next one, if the LLC is an S corp, then is there a minimum income or which one can take 50% as salary to save self-employment tax? In your example, your income was 100K.
Yeah, I typically tell people, that it's not worth converting an LLC to an S corporation until your income hits about 75, net income hits about 75K, because you're going to have to pay for a payroll service. There's typically another, business tax return you have to do. So you want to make sure that that tax savings is going to not be just eaten up with professional fees, right? So that's why, I typically use $100,000 in my examples, but 75,000 is the starting point, in my opinion.
Awesome. And so to clarify on one of the questions, so if I'm a passive investor in a syndication, would I be able to use bonus depreciation to offset the capital gains on the sale of that property?
When the property is sold, all carried over gains, all carried over losses that have accumulated are used to offset the income pass through on, from the sale. And yeah, so yes, the answer is in the last year, yes, you are able to use those.
Well, is there a way to adjust capital gains from stock, even with qualified RE professional against depreciation loss?
Can you say that again, John? I'm so sorry.
Yes, say that again.
So is there a way to adjust capital gains from stock, even with qualified, so even if you're a qualified real estate professional against depreciation loss? Oh, so can you take your depreciation from being a real estate professional and depreciate that, or take the losses against your stock gains?
Yes, you can.
Nice.
Yeah, any income.
That's good to know.
Assuming you qualify, your bonus depreciation losses are going to offset whatever other income you have. Doesn't matter. Most people are offsetting ordinary income, but you can offset capital gains also.
All right, it looks like the last one. So can you have a corp that is treated as an S corp converted to an LLC treated as an S corp? So let me see.
No, if you've set up a corporation initially, then you can convert it to an S corporation. It would convert from a C to an S. So a typical standard corporation is a C corporation. It can be converted to an S corporation. You can also set up an LLC and convert it to an S corporation. But when you convert an LLC to an S corporation, what you're doing is you're saying, I want my LLC to be treated as a corporation. So there's two elections. The first one is I want it to be treated as a corporation. The second election is now that I'm a corporation, I want it to be treated as an S corporation.
Perfect. That was good. And that was the last question there.
All right, all right. Thank you so much, Ted. Thank you for all the investors and all the great friends who were able to register. I think we had 160, 50, 60 register, and I don't know how many showed, at the seminar. We will be doing this kind of seminar every 3 months, and also several other kinds of seminars we'll be putting together. I just want to say thank you to everybody. Actually, we do the master coaching every Wednesday night, 4 p.m. Every Wednesday, 4 p.m. Pacific, because I live near San Francisco in Danville, Blackhawk. And I've been doing it. I just showed some of the other podcasts if you are interested, or the books that we are putting out, and a lot of educational things. And we have done a lot of syndications. Some of you are brand new. You may not know me at all. I'm Vinney Chopra. We have done 35 syndications so far. and also amounting to over $421 million in the portfolio. So lots of our, investors, if you're interested in passively investing in the future projects, please reach out to us. John, do we have any? I don't see any slide at all, which shows us where they could reach us.
So everybody will get a follow-up email with more
Oh,
contact information.
okay.
So if anybody has questions, you'll get an email with directly to us. So
Excellent. If there are no more further questions, really appreciate that. And maybe we'll just wrap up. Ted, again, thank you so much.
Really, thank you so much. I appreciate it. Both you and John. Thank you. Thank you
And
to
please
everybody on
do
the call.
reach out to my friend Ted. He'll be able to visit with you on Zoom or talk to you, strategy session, things like that. And John, I don't think we have anything else in the mastermind. Anybody's got any questions? I saw some students and investors joining us tonight, but usually.
does anybody want to ask Vinney any questions tonight before we wrap up?
Yeah.
I have a quick question for Vinney. Vinney, this is Suki. I'm from Bakersfield, California. I was wondering, how can I reach you? Like, if you can share your email or phone number.
Oh, sure. I think John will put it in the chat. It's Vinney, Vinney, at vinneychopra.com. So that's my website, vinneychopra.com. You could see everything, what we have been doing. And now we are into senior assisted living big times. That's why we are coming up with the book also that you will all see very soon. And this is the safest class of asset in apartments, multifamily, that you can ever invest in. The reason we say that is because there is a huge need and there is a big demand for senior living, assisted senior living actually. So we are in a different phase where people need to live in luxury, and that's what we built and so forth. So I just want to mention, you could reach us, Vinney at vinneychopra.com. Thank you. Thank you so much. So if anybody else has any question, I'm here to answer. Usually we do deal analysis. We do a lot of marketing things. We talk about branding. We talk about lots of great things. How to underwrite the property. Should we pull the trigger on this property or that property? We look at the IRRs and the cap rates and lots of great things, and how to talk to broker, how to get investors, things like that. So passive investors, active investors, syndications, that's what the whole program is. And that's, we also have a university, by the way. John is the VP of the academy, and where I've recorded 1,000 lectures, 1,000 on every subject, how to go about and develop the underwriting tools and other things that we also have on the online section, also group coaching and master coaching, which is personal coaching also, yeah. Okay, if there is no more question, we'll say thank you to everybody. Is there any other question?
Quick question.
Yeah.
Hi.
Please.
My name is Sudhi. I had a quick question. I came in a little late.
Sure.
So I wanted to check if our guest for today, the one who spoke about the details, the whole entire thing, is his contact number or contact details also shareable so that way?
Oh yes, definitely. Ted Lanzaro, we had his PowerPoint. You could actually email John. Could we put it on the text, please, quickly? It's Ted at LanzaroCPA.com, right, Ted?
Okay.
Yeah, so I put it in the chat. We'll also send out in an email the follow-up with the recording, so everybody will have that as well.
Oh yes, everybody will have also the recording, and we'll be doing this every 3 months. I was talking to Ted. Actually, our team is also putting together, high net worth professionals passive investing summit, which will be in March or April. We are still looking at it. It'll be over the weekend so that lots of people can attend that. It'll be free, actually. Can you believe it? You will pay some money up front, but after 2 days, we'll refund you the money. How's that? But we just want to make sure that people just don't, register and take up the space and not come to attend the summit. But that's a new thing. We don't need any money at all. We want to really give the education to lots and lots of, and we'll have a lot of other experts who will be joining hands in that summit. It'll be on Saturday and Sunday, because that's the time when we can really spend, easy time rather than away from work and so on. So thank you again. Good night. And thank you for taking the time out of your busy this evening, all through USA, from San Francisco to Florida to Maine. I mean, we had people from all over. So thank you again. God bless you all. And we'll also send you the recording of this. Also, if you want the deck, we could even send the deck. I don't know, Ted, I didn't really ask you, but, please reach
I
out.
can share that, yeah.
Oh, sure. Because we want to give, a lot of great information to all of you. Huh? Thank you again. And again, these are my 2 podcasts and 2 shows. So 4 things every week. So there's so much information which can really, really help lots of people how to invest right and so forth. Our investors are reaching us now $500,000, $1 million. They're just listening and reading my book. They're saying, Vinney, I mean, this is the way to do it. So it's very exciting for us to really, present these different things right there. Thank you again. Thank you very much. Good night.
Thank you, guys.
Thank you so much. Sure.
Thanks.
Thank you. Thank you. Let's see, John, how do we get out of there? Let's see. Okay,
Right,
there.
I'll end it. Good night.